This is 8-Minute Market Structure by Texture Capital, bringing you concise, expert insight for better markets. And now your host, Richard Johnson.
Hello, and welcome to the second episode of 8-Minute Market Structure, where I speak with industry experts and get their take on the most important market structure issues. It's a simple format, the same question for every guest. If you were building a new market structure from scratch and could change one thing, what would it be? It's one topic, no prep calls, just 8 minutes of concise expert insight for better markets. My name is Richard Johnson. I'm the CEO and founder of Texture Capital. We're a FINRA member broker-dealer specializing in digital asset securities, sometimes called security tokens. And we help investors and companies more efficiently access private markets by providing tools for tokenization, issuance, and secondary market liquidity. Today's guest is Mike Masone. Mike is the head of North American market structure for Citi, where he advises clients on market structure and advocates for market structure policy, frequently meeting with regulators at the SEC and FINRA and congressional staffers. Michael was previously chair of SIFMA's Equity Markets and Trading Committee and began his career as a securities lawyer. So it's safe to say, Mike, that you know a thing or two about market structure. So let me put the question to you. If you were building a new market structure from scratch and could change one thing, what would it be?
Well, thanks, Rich. I appreciate it. Thanks for the opportunity to do this, and I love the question. You know, we give a lot of thought to this.
Right?
You know, equities is in my blood, so I kind of look at it through that lens. Although increasingly trying to view these things from a cross-asset perspective, I think that's really an area of focus for the SEC. Although, you know, given the events of this year with GameStop, you can never really get too far afield from equity market structure. People critique equity markets as being overly complicated. You know, it is an incredibly intricate patchwork of market participants and regulation, and it's sort of come together like a quilt over time. And I guess if you were starting from scratch, it may not look exactly the way it does. But in reality, the U.S. equity markets are sort of tip of the spear in terms of you know, their efficiency and you know, especially for retail investors, even in the midst of things like GameStop. You know, you look at the experience that retail has, and it's second to none. You know, retail is trading for free. Or at least for zero commissions. Nothing is actually free, but without commissions, and you know, their access to markets is unparalleled. Their executions are quick, efficient. Spreads are super narrow. You know, at least in most securities. Overall, it's a really, really good experience. And so we're not too far off when you look at the U.S. equity markets. But what I look at when I'm thinking about how do we create a market structure that works for everybody, I mean, I'm a big believer that if you're, you know, the best thing you can do is just to try to get out of the way of market participants and allow them to compete on a fair and level playing field. You know, I'm a huge advocate for free market competition and for, you know, transparency, disclosure, and then let market participants do what market participants will do. And typically, you know, the results are pretty good. If I were to change one thing about the way our markets operate now, and I look at, you know, where are the inefficiencies in today's markets, you know, one that's getting a ton of attention now in light of GameStop and, you know, some of the congressional hearings around it and the scrutiny of retail order flow, you know, being executed and really concentrated among just a handful of market makers who pay for that order flow, and there are potential or, you know, actual or perceived conflicts around that. You know, what I think would really improve that overall is just to allow, you know, have the rules be written such that there's more free market competition for order flow, not only by market makers, but by exchanges. So there's a lot of attention being paid now to Rule 612, the sub-penny quoting rule under Reg NMS, you know, and a lot of calls to change that to allow for exchanges like market makers to be able to quote in sub-pennies. And so, you know, there's a proposal on the table that it's getting a lot of traction these days to move to half-penny increments across the board, so that exchanges and market makers are competing on a fair and level playing field. Maybe that would impact, you know, some of the concentration of retail order flow in the hands of just a small handful of market makers. At the end of the day, it may not have much of an impact at all. There's a number of reasons why market makers are able to compete pretty fiercely for that flow. But I think just having a more fair and level playing field and allowing exchanges to compete. Look, I'm no advocate for exchanges generally, but I do think that that the ability for all market participants to compete on a fair and level playing field would certainly make the market structure better. Now, the flip side of that is exchanges have, at least in the current construct under Reg NMS, been sort of afforded this preferential position where exchanges at one point were member owned. They weren't as they are now for-profit publicly traded companies. Who rightfully so answer to shareholders, not necessarily the market. At one point, exchanges were kind of viewed as sort of bastions of market integrity, and as such were given privileges in the form of a judicial doctrine called regulatory immunity, but otherwise their ability to limit their own liability. The thought being, we don't want these exchanges going out of business. And I get that, yeah. But on the other hand, all market participants need to be responsible for their actions in the marketplace. So, if on the one hand you wanted to level the playing field by allowing exchanges to more fairly compete for that flow, then on the other hand, I think you need to have exchanges be fully responsible, as the rest of the community is, for the issues that they create. I mean, the most obvious example of this was the Facebook IPO, where Nasdaq, even after its admission that because of its own technology issues, caused a lot of harm, a lot of financial harm in the market, was still able and afforded the opportunity to basically stand behind the doctrines of regulatory immunity and limit their own liability and basically pawn that off to the marketplace. I don't think that's good for markets generally, and it's really I don't think it would be right for broker dealers to be able to do that, or for exchanges to be able to do that, or market makers. I just feel like if you really want to create a better market structure, level the playing field for all, and then create that sandbox, and then let people market participants compete like heck for that order flow.
So I totally understand what you're saying when it comes to the liability for the exchanges. I was on a trading desk, I think it was SocGen, when Facebook did the IPO. We lost money on the market on open there. Firms like Citi lost a lot more money. I don't know what the losses were across the street, but I think it was certainly in the tens of millions of dollars. Somehow the exchanges managed to demutualize and become for-profit entities, but keep their limitations on liability. But getting back to your first point, let's focus on that. Rule 612, the sub-penny pricing, it was explicitly banned essentially in Reg NMS by exchanges. What this is saying essentially is that exchanges will be able to quote in less than sub-penny increments. So right now, the minimum spread is a penny, and you're saying essentially let that be smaller, because that's what market makers are able to do when they're kind of internalized, and they can price improve for 1/100 of a penny, and that wins them some business. But what stocks is that going to benefit? That's surely only going to benefit the most liquid securities. Do you agree with that?
Yeah, look, I mean, first and foremost, I'm certainly not advocating for massive changes. What I'm simply saying is there are ways that we can level a playing field. Yeah. And as I look at this, you take a step back. I mean, the whole point of 8-minute market structure is really at a high level. What are we trying to accomplish? And what I think we're trying to accomplish is just leveling a playing field for all. In this particular case, this is the one that's being cited most often, where market makers are able to quote in 4 decimal places to the right. And that business, Citi ran a retail market maker for many years, ATD, and I can tell you with firsthand knowledge, it's an incredibly competitive business. Profitability measured 4 decimal places to the right. You're basically, it's a volume game. It's a scale game, and unless you have scale, you're not going to compete in that business. And exchanges can't even really get there because they are bound by this artificially wide quoting increment of a penny under Rule 612. And there may have been reasons for that when NMS was passed back in 2005. And I'm just simply saying, if we're looking for ways to kind of level the playing field, eventually, or at the end of the day, what we're trying to do is have the benefit inure to the underlying investor, in this case, retail. I'm not sure it could get that much better for retail than what they have now, but certainly the ability to compete on a broader scale. And to your point on the liability issue, it was actually more in the hundreds of millions of dollars that the industry as a whole lost. And I say this not because it was this one isolated event, but instead, as a market maker, what you're trying to do as a market maker is provide, create deep liquid markets with very narrow spreads. And in a business where
let's drill down a bit. Would you go to 4 places to the right, 1/10 of a penny, 1/2 a penny? What do you think is the right balance? Because let's not forget, there's a big market data implication as well. Like,
of course,
the market data is going to multiply as soon as you start doing that, and also complaining about the cost of market data out there.
Yeah, the market. There's always a market data component to everything,
Yeah, right.
and that would be for the 8-hour market structure. But we only have 8 minutes. What we're I think if you right now, by allowing by market makers being able to sub-penny quote out to 4 decimal places, if exchanges were even allowed to then quote in half pennies, but we're still at a disadvantage vis-a-vis the market makers, it doesn't seem to me that you're solving anything there. You still have an unlevel playing field.
Yeah.
I think what people are proposing, and again, I'm not advocating for this. I think the debate around this is about to really kind of come to the fore.
Ideas here. I like it. Yeah.
I think that what I think people are calling for is a half penny increment across the board, such
market
that
makers and exchanges,
market makers and exchanges, and then you're really competing on price and execution quality and all the things that you should be competing on. But the regulatory structure, the market structure itself, would sort of get out of the way and just allow market participants then to compete, on their merits. And I think that's ultimately the goal that we're trying to achieve.
Obviously, we could talk about this all day, but then it wouldn't be called 8-minute market structure. We are out of time. Thanks so much for your insight, Mike. And hopefully we can continue this conversation on social media.
Great. Thank you very much, Richard.
Thanks a lot.
This has been 8-Minute Market Structure. Be sure to follow Texture Capital on LinkedIn, where we will release a new episode every week. You can also find us on Twitter at texture_capital and on the web at texture.capital. The foregoing discussion is for information purposes only and does not constitute a solicitation to buy or sell securities. Private securities offerings are not registered with the SEC and are considered highly speculative. An investment in private securities may result in the loss of your entire capital contribution. Blockchain is a new technology and unproven in financial markets. There is no guarantee that tokenization will enable any secondary market liquidity in the future.